Let's go.
Hi, and welcome to Inside Trading. This show is all about trading. Every week, we discuss what trading is all about and the required habits of being a successful trader. We also share trading ideas and themes all about making you more money. Now, with me today is, as always, my co host Phan Leung. He's the founder and CIO of TrackRecord Trading Academy. V, as always, great to have you on the show.
Hey, Brian, let's talk about trading.
Now, absolutely. For a start, as we always do, we start with a quote. And today's quote is from George Soros.
So, what he says is that if investing is entertaining, if you're having fun, you're probably not making a lot of money. And why? Because good investing is supposed to be boring, right? This is not just something George Soros says, but many market legends also say that, right? So, what do you think that means to you, Brian?
Now, good investing is boring means be patient, look at trends, and don't try to overtrade, as we've been talking about in this show over the last several weeks.
Yes, that's exactly true. So it's a bit counter to what we typically see in popular financial media. When if you see a news program about finance, they always have this exciting music in the background, and then the charts goes, and then the sound effects, and it seems like the markets are moving a lot. That you should be doing something, but typically if you are not a professional trader, you generally don't need to do anything most of the time, right? You just need to keep tabs and understand what's going on and understand what's the predominant themes that are driving the market. Because the themes that drive the markets do not really change on a day-to-day basis, right? Of course, sometimes they get affected by news, but not so often that you should be having so much excitement and so much fun in keep in clicking here and there, right? So it's there's a disconnect between real investing and what the popular press would have you believe, or Hollywood productions would have you believe.
And today the theme is now, shifting from the inflationary theme to the deflationary theme or disinflation theme.
Yes, exactly. So let's talk about that. The disinflation trend continues, as we saw in the latest US CPI data, inflation data, consumer price index. It showed that prices rose 3% in June on a year-to-year basis versus 3.1% expected. So that's great. It's lower than expected. But more importantly, it's a big drop from the previous observation of 4%. This is the lowest observation of inflation since March 2021. And the core index, which excludes more volatile components such as food and energy prices, it showed that prices rose at 4.8%, lower than the 5% expected, and much lower as well from the previous observation of 5.3%, and that's the lowest since October 2021. So if you break it down, you see inflation moderating in the food components, in the shelter components, and interestingly, in the energy costs, we are seeing deflation, right? Prices have basically collapsed from the highs of last year. So this is what we've been talking about. We talked about this in last episode as well. Uh, Inflation is moderating at a faster pace than most commentators expect, and even faster than the Fed expects. So that's a
And also, I
disinflation
want to
trend.
just jump in here now and to remind the audience that the Fed's target is 2%.
Yes, it's 2%. So they still think it's above 2%. That's a problem to them. But of course, we are seeing a very strong disinflation trend headed towards the 2% target. But this is in the US. What about elsewhere in the world? We are seeing China inflation at zero, right? It's come off from above 2% in last year to now at zero. So there is no inflation. There is actually possibility of deflation in China now. And using the producer price index, which is what the producers of goods are seeing as their input cost, you're seeing uh, deflation. You're seeing costs are dropping by more than 5% on year to year basis, and it has been this way since late last year. That is below zero, right? So we are concerned about this because China is the manufacturing hub of the world. Although yes, there's a lot of efforts now by governments to diversify their supply chain from China, but still remains a producer of many of the goods that we buy. Lower prices will be passed on as lower import export prices from China, and we are seeing strong deflationary pressure from China in it's exported globally. So what does that what does the Fed say about the latest inflation data point as well as the disinflation trend that they're seeing? They continue to downplay disinflation. Barkin, a voter next year, said immediately after the CPI data was released, inflation remains too high because whatever is 3% is above the target. And he is comfortable with more policy tightening. So they're now still thinking about hiking interest rates as long as data does not confirm that inflation will return to 2%. Right? A voter, Kashkari, also said inflation proves to be more entrenched than expected. Policy rates need to go higher. I'm not sure how they still think that is becoming more entrenched, but in fact, it's coming off lower. So as a recap, this is one of our favorite charts that we've been showing. If you look at since the beginning of last year, January, as inflation was going up, the Fed said inflation is transitory because they were very used to an environment, a world where inflation was below their 2% target. It's like doomsday scenario in those days, right? And as inflation went higher as the year progressed, they finally caved in November. They said it is not transitory anymore. This is not a term we're going to use to describe inflation. And then they finally hiked interest rates as it went higher, and they hike more aggressively. The yellow bars are the size of the interest rate hikes. They started to do 75 basis points hikes in June last year. And as they hike more and more, of course, the lagged impacts, you do not affect the economy immediately with an interest rate hike. It takes time to filter through, and all the lagged effects are coming through now, and we are seeing now inflation drop from the highs of 9.1% to now 3%. And what they're telling us now is that inflation is too high, upside risks remain, which in layman terms, it means this inflation which we have been seeing since the end of last year is transitory, right? This is what they're trying to tell us.
And
But
this is what we mentioned in the last week's show.
exactly. So it's good to recap. It may be boring, but this is a theme that we're going to expound on for many, many more months to come. If there is no new drivers of inflation, right? There's no, for example, a war that again constricts supply chains, restricts supply chain with trade war, uh, anything of that sort, or a supply shock to the energy prices, right? We do not see a persistent factor that drives prices higher from here. Likely the lagged impacts, the effective tightening of the aggressive rate hikes of last year will start to continue to filter through. We will see more disinflation going forward.
So then if we believe this thesis that we're going to have disinflation, how should we as investors react to this? Because obviously stock markets are on a tear.
Yes, and I think stock markets are on the tear, right? And then this is something that we talked about as well, right? Like there it's not obvious why stocks are going higher, but stocks tend to discount present information and start to predict future paths, future outcomes, right? And I believe that investors are starting to collectively see that we are very close to the end of the aggressive hiking cycle, right? The even if, right, for example, let's just say nominal interest rates, which is the policy interest rates, is at 5%, and even if they don't increase nominal interest rates, uh, subtracting inflation, which gives you real interest rates, that's what affects the economy, right? With inflation last month at 4%, we had real interest rates at 1%, 5 minus 4, 1%.
Mhm.
But now inflation is at 3, 5 minus 3 is 2%. So in fact, the drag on the economy has gone up, right? It's going to be even tighter conditions as inflation drops. The tightening effects increases as well. So we do see a slowdown in the economy, continuing the disinflation, and market are pricing the likelihood of the end of the hiking cycle, right? That's why we are seeing. But the question you want to ask, right, is the Fed going to be right this time? I'm not sure. Given this chart, does it seem like they're going to be right? So one way to look at it is that the US economy is like an oil tanker, right?
Okay.
To maneuver it, it takes time. To accelerate it, it takes time. To slow it down, it takes time. When we were at inflation at 9%, the target was 2%. It makes sense to step on the accelerator and say, let's head towards 2% aggressively, right? Let's
Yes,
hike.
because there was such a big gap. There was a 7% spread at that time.
Exactly. So at that time, inflation was 2% target was beyond the horizon, cannot be seen, right? But now we're very close. We're very close. We can see it. It's just right there. Possibly 2 3 months in the future if this inflation trend continues. But somehow they don't predict this. They predict more persistent inflation. But that's not what we are seeing in the data. The data is surprising to the downside. So is it time now to continue to increase speed towards the destination, or you say maybe we should let our present speed now bring us closer to the destination, right? So I think that is the critical question that we have to ask here.
And so then, as an investor, what should I be doing?
So I think the rally continues, right? I think you are now prepared. We should be prepared for the end of the hiking cycle, unless we do see any flare ups, any price surges, any factor that will drive prices higher. For example, RK, which is the ETF run by Katie Woods, who was a hero before during the pandemic, and then became the villain of the bear market because it's so heavily invested, right? And it's the most
But it's
hated
come back
ETF.
up.
Yeah, it's now breaking higher, and if and it's also a good market uh, truism. It's something that you should always think about. If the weakest of the lot is starting to become strong again, that means the herd is extremely strong, right? As we can see on the Nasdaq daily chart as well, Nasdaq, the tech index that was crushed during the bear markets of 2021, 2022. We are seeing it breaking to new yearly highs, and it's the highest level since last year as well. So I think we have to be prepared for an environment where it's more conducive to investing, a friendlier investment climate for stocks, risk assets, and other asset classes that we'll be talking about soon as well.
Now, on that note, V, thank you very much for your insights. And that's it for today's Inside Trading. Uh,
Okay, see
I'm
you again
Brian
soon.
I'm Brian Fernandez, and we've been speaking to Pang Leung, the founder and CIO of TrackRecord Trading Academy. And this has been BizTech's Inside Trading Show. This interview will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.